Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, October 18th. Well, down in the Southwest Florida area here, it's been 10 days of cleanup, coming along nicely. Thanks for all your emails and phone calls. They're much appreciated. Busy week this week. You wouldn't know it as much from the indexes, right? S&P up about 3/4 of a point, NASDAQ flat, but under the hood, real bid in financials and industrials. Remember, for years, for 2-3 years, it was tech. Now, tech's still trading fine, and semis are volatile, but have a little bit of a bid versus 2 months ago. But boy, real strength out of banks and out of insurance companies. One of the things we were looking at was to see how the property and casualty insurers would respond to the double dose of Hurricane Helene and then Milton. Here they are making 52-week highs, and many of them making all-time highs. Very interesting. Means the street investors feel like they had that risk booked properly. So with financials underpinning this market right now, there's an awful lot of breeze at your back. What we own is working. Wherever we have frustration right now is where we're playing some defense with cash. The market has 1-day, 2-day sell-offs, steep intraday drops, but recovers very quickly. There's a strong bid under the market. That'll change as time goes on. We know this is cyclical, but in terms of what's working, it's broad. And for the past 6 months anyway, there's been a nice bid to small cap and mid cap. So it hasn't just been that large cap growth area that was so strong for 2023 and the first 4 or 5 months of 24. Where are we looking to put some capital to work? I mentioned financials. We have some leverage into that asset class, into that sector, but I feel like we're a little short there and a little light. So we'll be looking to add to the financials. We will keep adding to industrials. Why? They've been a home run trade for us, understanding that. The earnings are outstripping the growth in the share price. That's a magical combination when you're in a sector or in an industry and you're maybe thinking that it has gotten a little bit ahead of itself, and earnings come out and are much better than expected. So we're getting a good pull out of industrials. Don't forget, we include in industrials the defense sector. We know it's a dangerous world. We see what's going on in Ukraine and Russia. We see what's happening in the Middle East. XAR, one of our large holdings in U.S. equity ETF, continues to make all-time highs. How about in bonds? What are bonds trying to tell us? Well, they're trying to tell us that right now, between the Fed and the economy, things look pretty good. That 10-year Treasury, recall back a month ago, was flirting with 370, 375, backed up to 405, 407, 409, closed that last week, about 407 today. I'll tell you what we would take. We would take a 10-year between 350 and 4.25. You can make money on your yield and coupon, and it doesn't pressure the lending markets enough to slow down the economy substantially. So we're bracketing our thought pattern on fixed income in that 350 to 4.25 10-year Treasury. Munis, of course, do trade separately from Treasuries and have been very strong versus Treasuries. Remember, we want to look at those two bonds and compare and contrast them. At times, munis are very, very weak versus Treasuries. Think of last year when we could buy munis, long munis at almost 5, on par with where Treasuries were trading. This year, not so much. You know, Treasuries and munis have gotten back in line. A 4.10 10-year on the Treasury, probably yielding in a 10-year muni, 3.25, 3.30, and I'll let Moose talk more to that next week. So quick wrap up, we'll be looking to get money to work at reasonable prices next week. Enjoy the weekend.